Well, good evening, everybody, especially those of you that are joining us from those stormy locations we were just talking about. Welcome to the April 2016 Roundtable. We'll be joined tonight by Hugh McManus. Hopefully, he was on his way to San Diego, and hopefully will be arriving any minute. I'm joined here by my good friend Ken Kabula. My name is Mark Robertson, and Cy Lynch is unable to join us tonight because he's finishing his finals, and we wish him all the best in that regard. We're going to basically feature a couple of stocks that we've picked in the past tonight, a couple of repeats, so the agenda should go pretty quickly. And we want to spend a little bit of time talking about this notion of maybe cleaning up the portfolio a little bit, maybe crystallizing some thinking on some selling concepts or guidelines. So we want to get to that. So we're going to probably roll through the regular agenda pretty quickly. And we are also going to spend some time talking about shopping not like the vultures, and I'm going to actually use the concept that Ann Manning has been proposing and teaching. That was Ann you heard just a few minutes ago. Why mess with it when there's plenty of things to choose from? Here's the standard disclaimer. No recommendation whatsoever is intended. This session is clearly intended to demonstrate the methods, the procedures, the analysis techniques of the modern investment club movement, whether it's NAIC or Better Investing or Manifest Investing based things. These are legacies that go back over 70 years now of groups of people who most commonly gather as investment clubs and subject companies to fairly rigorous analysis methods in choosing stocks and managing their portfolios. So again, this is for demonstration and illustrative purposes only. Thank you. Here's our standing agenda. We'll talk a little bit about our results, not going to dwell too much on those. We're going to kind of slide the general discussion to after we've presented the stocks tonight, just because we want to leave time and just kind of leave it open for the floor in case any of the audience people want to participate with any thoughts on the things that are shared. Our three stocks tonight are three stocks that are already in the roundtable tracking portfolio, and some of them have been fairly recent favorites. Illumina and Buffalo Wild Wings. Interesting story with that one coming as I present that. And he was going to go back to Staples at least one more time. Who knows if he'll continue to reinforce that one. Interestingly enough, Staples was one of the first selections made back in the second month of this roundtable series about 6 years ago. And he continues to believe that the company will be bought out at a premium, and he thinks that he can make some money doing that. We will poll the audience on those three. Like I say, we'll leave the floor open for Q&A after the discussion. So let's go ahead and get underway. Here's our reminder of what we're trying to do here. We're just sharing some of our favorite ideas at this time. That idea should be, in our opinion, positioned to outperform the total stock market as measured by the Wilshire 5000. We do keep track of how our selections do. You'll see some of that here tonight. We'd like to outperform the Wilshire 5000 by 5 percentage points over the long term. We're running at about 3 to 4% here lately, and closer to 3% lately. And we do like to see the majority of our selections actually beat the mirroring investments in the total stock market over time. Here's a quick look at our results. Again, in absolute terms, the rate of return is 12.2% per year since July 6 years ago. 52% of our selections have outperformed the market. And again, we kind of stand on one foot or click our heels together 3 times, and we like the trend here that we seem to be approaching that dotted red line, which is the beating the market by 5% over the long term. And again, relative return is simple. It's just comparing the actual return on the investments versus the return from a benchmark like the Wilshire 5000 in this case. And we'd like to beat it by 5 percentage points or 500 basis points if you speak that language. And again, the trend is good and has been quite favorable for quite some time now, and we hope to get up above that line. Any comments or questions on that, Ken?
No, we're staying pretty even. We have a good experienced audience, albeit a nice size one this evening, but most of our folks, I recognize a lot of the names, so let's keep going, Mark.
Okay.
Hey, I'm checking in to see if you can hear me.
Is that Hugh? Yes,
Good.
we can hear you just fine, Hugh.
Perfect. Just go back and mute them.
Are you in San Diego, or I guess he's muting?
I am, yeah. I've been on this for the last 10 minutes, so a bit more.
Okay, fantastic. Welcome.
Thanks.
All right, here's a quick look at the dashboard for the portfolio. It's a manifest investing dashboard. It is public. If you use that link up at the top, you do not have to be a subscriber to manifest investing to access the list of total holdings. What we do is we invest $1,000 into each idea or each selection at the time they're made, and any time that it's repeated. So any one of the participants, whether it's a knight or a guest damsel or a guest knight or the audience, when the audience makes a selection, we will invest $1,000 into an idea. So in the case of Cognizant Technology, for example, up at the top, it has been selected, I believe, 12 times. We'll show you where to find that information in a second. So $12,000 has become almost $19,000, over the last several years. Apple's another one that's done fairly well. I'll go ahead and jump out and show you exactly what I mean by that. If you go to that public dashboard that we mentioned, and go to that link, you can actually see the number of times that the selections have been made. Here's Cognizant in the case of 12-time selection. Apple's an 8-time selection. He will be selecting Staples tonight for the 8th time. So that when you see him on that portfolio during the review, again, these are just the top 20 holdings. It's a long list, as you can see as I'm paging down. Ken loves to spend his time down here looking at the ones that have only been selected once and have done extremely well. Some like, this is one of Ken's right here, Skyworks, one-time selection, $1,700. So again, just something we would recommend you take a look at. These are obviously the positions that are going to affect the overall portfolio performance the most. The one thing that we do take away here tonight is that the portfolio is not in the sweet spot. That lower right-hand corner where it says 10.2%, we'd really love for that to be 11% or more right now. The average stock is somewhere around 6%. We'd like to see that closer to 11. Hopefully the selections we make tonight will bolster that a little bit. Quality's pretty good at 84, and growth is just a tiny bit low at 9%. We'd kind of like to see that up closer to at least 10, if not 11% also. So just a little bit short of the target ranges for where we'd want to be on both the growth of the portfolio, it's a weighted average, and the overall return forecast, which is the projected average return. So any questions or comments on any of those particular holdings? Ken?
No, we're still holding pretty well on our question panel, Mark, so you can keep moving.
Okay. So we're going to just go ahead and trudge right into the stock selections tonight. This is a repeat selection, and I'll just have Ken take us away with Illumina.
Okay. Illumina is a stock that I really, I hate to say that I've fallen in love with it, but I really think that this stock has a lot of future potential. I think that it's under the radar of a lot of people. I think that there are people that don't really understand the capabilities that this company has to change the world of medicine and of healthcare. But let's talk a little bit about the company. Mark, if you'll click. The mission of the company, to improve human health by unlocking the human genome. Click again. And they serve a large number of markets. It's not just focused on oncology, on cancer, or on research, but you can see the huge number of industries that this company services by sequencing the genome and looking for ways to use what they find in the genome to help in these different industries. Click again.
No, I'm going down.
We're getting some background noise, so if you can mute yourself in the background. Illumina feels that it's scratching about a 20 billion or so market going forward, and it's just barely registering in some of the different markets. I boxed in the footnote at the bottom of this page because the footnote refers to a brand new company that Jeff Bezos of Amazon fame, the founder of Microsoft, the richest man in the world, and Illumina have put together a new company called Grail. And if you're interested in this company, I would urge you to go to their website and look at the PowerPoint presentation about this new company called Grail. Grail is going to be focused on coming up with blood tests that can detect cancer in its extreme earliest stages. If they in fact can move in that direction, then they can tailor drugs based on the individual genome to cure that cancer before it becomes something that's incurable. And Grail is hoping to move very quickly to come up with these tests and then to find ways of utilizing them in the field of oncology. So I think it's a very interesting investment that Illumina is making, and they're going to put quite a few dollars behind this new company. And as I mentioned, Mr. Gates and Mr. Bezos are also putting a few dollars behind the venture. It'd be something very interesting to follow in the next 3 or 4 years, I think. Another click, Mark?
Okay. Just a quick question, Ken, from me. Is Grail still a private company? Is it just informal?
Grail will be a private company held by some individual investors and held by Illumina, but it will be basically owned by just the investors that are putting the money forward right now. There are some other investors, but the two marquee names are Gates and Bezos, and then Illumina is going to take a large position in the management of the new company and getting it off the ground. And then they're going to be using a lot of the tools that Illumina makes to begin to deal with these new kinds of blood tests.
Okay, well, let me know when they get Hugh McManus on the marquee too.
Okay, all right. You can see that Illumina makes a lot of different machines. They all basically are after sequencing the genome, but you can see that the prices are significantly different depending on how large the machine is. You can see that the price of the machines themselves are also significantly different. So there's not one size fits all in these machines. It depends on what you need and what your resources are, and you buy a machine that fits your needs and your resources. You can see that right now they've installed quite a few of the higher end machines, and they're beginning to work now on these very, very low end machines that will sell for $12,000 to $15,000 a piece. Right now, 0 of them installed, but the machines are ready. The mini sequence machines are ready to be rolled out and sold to different customers. Click again, Mark. Some of you have heard of Moore's Law before. It was a law that spoke about scientific accomplishment. There was a lot of talking about Moore's Law as computer chips were completely redesigned and then redesigned again and then redesigned again, and how their price came down dramatically. Some of us lived through that, from extremely expensive machines that did very little to fairly cheap machines today that do 100 or 1,000 or 10,000 times what our first machines did. The same thing is happening in the sequencing technology. In fact, it's moving down even quicker than Moore's Law would anticipate. Back in 2002, you wanted to sequence a human gene, maybe $100 million. Today, 2013, 2014, down to 1,000, and the goal is bring it to the low 100s within the next 2 or 3 years. It's certainly going to be historic when we can start to design drugs, when the microbiologists can start to design drugs based on your particular genome. Click again, Mark. They leverage their technology. I like to call it the Gillette model. They do make the machines, the sequencers, but they also make all the supplies for the sequencers. You can see that all of the different things are made by this single company, and they all help contribute to the bottom line. But if you'll click again, Mark, you'll notice that I'm looking at the top left-hand graph. You'll notice that the consumable part of the business right now is making 58% of the revenue. Then they do sell the machines. They also service the machines, but they're getting the majority of the revenue from consumables. That's just like the Gillette razor. You know, they would sell you the razor part and then continue to sell your blades for the rest of your life. These other graphs are interesting. Most of the units right now are sold in North America. About a little bit less than 2/3 are sold in North America. That's the bottom right graph. You can see that they're doing most of their shipping to the Americas as well. I'm sorry, they're doing most of their shipping, they're selling most to the Americas. The bottom right graph is clinical versus non-clinical. So they sell to universities, they sell to research facilities, but they also sell to hospitals and doctors' offices and things like that. You can see the breakdown by academia versus commercial clients in the bottom left, and again 2/3 to 1/3 approximately. So it has a lot of different kinds of customers sold in a lot of different kinds of places and relying on things that have a pretty constant stream attached to them once the machine is sold to a client. Click again. Here we are at Mark's page, the Manifest Investing page on Illumina. He gives it a call in the healthcare sector, medical supplies. I think that's a pretty accurate call. And most recently, in fact, today this slide is from, I'm getting a really high quality rating and a nice high par. In fact, Illumina, if you look off to the side on this page, you'll see that Illumina is one of the top healthcare companies, and it's definitely the top company in the medical supplies industry. Mark gives you some comparisons of other companies off to the side whenever you look at one of these pages, and Illumina ranks really nicely either in the sector or the industry. A pretty nice par value, around 18%, a pretty healthy PE ratio, average PE ratio of around 40 or so. So this is not cheap. You're going to pay for the growth. And when a company carries a PE ratio like this, if its growth's not exactly what you're anticipating, sometimes these companies take big hits. The price on these kinds of companies is awfully volatile. The last time I chose Illumina was back last September, and the price was about $35, $40 higher than it is right now today. Click again, please, Mark. I love to look at this chronicle at the bottom of all of the pages for all of the stocks. I'm looking for a stock that has a nice consistent quality rating for the last couple of years, and I don't mind seeing one that's been moving consistently upward like this one and then seems to have plateaued somewhere in the mid to high 90s. At a 19% par value, that's historically pretty high as far as par is concerned. Notice it did peak about 6 or 8 months ago, a par value up above 20, but I think 19 is a great historically high par. It's a good time to be looking at the company and giving me this kind of return. Click again. I've circled here on the eagle, I've circled the places that essentially you can give input to kind of change the eagle to fit what you think is going to happen. The analysts feel that sales growth will move at about 20%. That's the circle in the middle at the top of the page there. And then going down the right-hand column, the analysts are calling margin at about 23%, share count a little bit more than 150 million, and a forward PE of about 40. That's in line with the values that Mark was using to come up with the par of 18.8, almost 19%. Now, if you click again, this is the eagle that I put together. I chose to lower the sales a little bit to 17. The company is setting a target of between 16 and 18. So I just chose the midpoint of their target sales number for the next 2 or 3 years. It's not a 5-year target for the company, but it is a 2 or 3 year target number. I've decided that I'm more comfortable with a PE of in the mid-30s. So actually, I'll be looking for a little bit of PE contraction. But even with those things happening, I'm still looking for a par value of about 13% on this eagle. I'm very, very comfortable with that. Click again, please, Mark. Here's the front of the SSG, the visual analysis on the SSG. It is right up to date with the most recent fiscal year included. You can see that things are moving along quite nicely. It does pay to look into the data just a little bit. The company does report GAAP earnings and non-GAAP earnings. They don't do a lot of significant changes to the GAAP numbers, but occasionally when you see earnings moving in the opposite direction of sales and you're using this Morningstar data that the toolkit does use, you'll notice that there's been some adjustments because the GAAP numbers and the non-GAAP numbers are a little bit different. I would compare them to another source that does normalize their data. ValueLine, for example, normalizes the data, and I think you'll see that they give some reasons why ValueLine might have slightly different earnings numbers going forward. But I like the trend on both of these. Notice that I've decided 17% sales growth and about 16% earnings growth, and the analyst's opinion for the next 2 years going forward seem to confirm that trend that I chose. The dots are right on those dotted lines, so that kind of confirms my calls for me, at least for the next couple of years. Click again, Mark. Here's the standard SSG. Great things happening in section 2. Remember that the toolkit on that debt line is giving you debt to equity, not debt to capital, and 50% debt to equity is the same as 33% debt to capital, which is the BI guideline. So that 2015 debt number is right in line with acceptable. The debt is moving in the right direction. The company has brought on some debt at very low interest rates. You can go to the Morningstar site and you can look at the borrowing that the company has done and see the interest rates attached to that borrowing. And they've borrowed a lot of money at 3, 4, 2.5% is the low number. And that says to me that they have some plans for this money, and in fact the creation of this new company Grail is where some of this cash, this capital is going to go. Notice that the company has never ever in the last 5 years traded at comfortable level PEs. Those are all astronomical gasp level PE values, and I've assumed a value of an average value of 40, 45. I've said that the average might be as high as 60 at the top and might be as high as 30 at the bottom. That's matching my eagle to a certain extent. Click again, please, if you would, Mark. I'm getting a stock in the buy range, 4-to-1 upside downside, no dividend, and I'm getting approximately the same return that Mark was getting, a little bit less, but we're in the same general ballpark. Lends some validation to my thought process. I'm pleased when I can be in the same ballpark as the analysts are by doing an independent analysis. So I think that Illumina, especially at the price that it's trading at right now, is something that has the potential to change the world of health science and of research in a way that we've never ever anticipated prior to the beginnings of understanding the human genome. It is the gorilla in the room. It's the big player. In many ways, it's the only player for fast sequencing, and it's being used throughout the world right now to create things that 10 years ago we could only think about creating, and we're actually doing it today. I'm going to add another position in Illumina to the portfolio.
Thanks, Ken. Might make a quick check for any questions if we want to check in with those right now. I didn't see any a minute ago, but give you a chance to take a look for that. I see that
I'm
Don's
still getting weather reports here, Mark. Hold it.
Don did ask, where do you find the recording on Manifest Investing? You can actually go to manifestinvesting.com/events, and many of them are there. And we'll be putting the recording in the forum also. If you have a special need for a recording, go ahead.
Ann wants to know, she says, my club recently bought Illumina just before the price dropped. Could you address that? Well, I think I did address it in my presentation. These types of stocks with high PEs are volatile. They're extremely volatile. And if they disappoint even a little bit, then you're going to see prices move in the downward direction. And that's PE contraction, and that happens when these really, really high PE companies do a little bit of disappointing. Mark, if you could go back to the graph that's showing the sales growth rate, it's back about 3 slides, I think, right there. Mm-hmm. You'll notice that the trend since 2008 has been at 21% for sales and 31% for earnings, and that seems pretty healthy. The very last quarter and the fiscal year came in a little bit less than those trends. They were still very healthy. They were still in the upper teens, lower 20s, but they were disappointing based on anticipated numbers coming in, and that's caused a price drop. It's no longer sitting at the 52-week low, but it's nowhere near its 52-week high either. You can see the price bar. I'm kind of showing it with my cursor. Well, you can't see my cursor because it's on Mark's machine, but there is a price bar up there you can take a look at there. He's drawing an arrow by it. But, and there doesn't have to be a reason for these high PE companies to move up and down 2, 3, 4% in any given day. And especially during earnings season, if there's any disappointment at all based on the high expectations that are set for these companies, then the market tends to do a knee-jerk kind of reaction. And frankly, since I'm in it for the long haul, since I think this company has a great long-term story, I find those opportunities to be buying opportunities. Yeah. In the last week and a half, I have added to my positions in Illumina when the price had moved down into the high 120s, low 130s in that general area. So I think that it's a great stock. Nobody can actually foretell the future. I'm not going to tell you you're going to make money in it, but I really like what the company is making and what they're doing.
The other thing to keep in mind is that some very big players are involved here, the institutions, and with that little bit of flattening you can see on the right-hand side there, they can be kind of volatile. They can be very quick on the trigger finger, and that can cause very sudden price movements. Because again, we're talking about people that are, throwing around millions of dollars with a keystroke. So, if not billions, in some cases. So again, it's going to be sensitive to that sort of activity. Anything else at this point, Ken, or should we press on?
I think we're pretty well taking care of the questions, Mark. So let's go on to what Ann had to say here. Okay,
let's go ahead. Ann is in the audience, so if you want to unmute her in case she wants to defend herself, we can do that. I went shopping for some stocks tonight. I always like to tell you where the ideas come from, so at least you can form some conclusions about that. And tonight I'm invoking the Ann Manning method. And the way I would characterize the Ann Manning method is why get frisky? Why get crazy with turnaround opportunities? And as you're going to hear about later on tonight, my outthinking myself in the Iconics brands moment from a year ago. And when you've got so many solid, fairly consistent, steady performers, and Ann comes at it from the standpoint of, why would you buy a company that's got all kinds of issues or disruptive situations, that sort of thing? A lot of times we'll talk about, well, their margins could improve and go back to historical levels, that sort of thing. So I'm looking for companies that don't fit that description, basically have demonstrated consistency. You're looking at a list of companies that have a manifest rank of 100. That means Their return forecasts and their quality rating or ranking are going to be very, very strong. They're probably in or near the buy zone, and they just have decent quality rankings compared to their competitors or peers. Starting with at the top of the list, Buffalo Wild Wings, company growing in the upper teens with a decent margin for a fast serve restaurant, a PE that's not inordinately high for a fairly young but emerging and maturing company. But again, you can see some of the other votes there. If a company made that list of, again, the top percentile of all the companies that we track, but there was a dissenting opinion from like a Goldman Sachs or Value Line or Standard & Poor's, I just set them aside. Why mess with it? Because one thing that I have learned over the years is that sometimes those strange opinions in left field come true. So in this case, Ann, do you have anything you would add to that when you're thinking about going out and shopping for stocks? Because again, you're one of our all-time leaders when it comes to performance in the groundhog. Is Ann with us still?
She is, but she is now unmuted. Ann, if you have anything to say.
Well, I didn't know we were doing this tonight. Thanks, Mark. Yeah, I, in the last few months, have really taken this to heart. And I've only been looking in I look in each sector and manifest every month, and I only find the companies of high quality that have a good PAR. And I have been doing really well the last few months. So I think it works.
Yeah, I just think, again, there's a company on here that has been relatively challenged here recently, Polaris. It's one of Ken's favorites. It's been presented here a couple of times. I've noticed that after a fairly steep price drop, that here in the last few weeks, it's been gently ticking upward. And when I say ticking upward, I'm talking about the fundamental expectations. They've actually returned. If you look over here in the middle of this one-year outlook, and again, I just wrote a big piece that basically said, I'm not sure we can even use these things, but in this case, the analyst consensus has improved from a fairly steeply negative expectation for the next year to, ticking up to where at least it has a positive outlook for the next year, and that may continue to improve as the company gets a good hold of things that they're looking at. I mean, Apple was asked about in the green room tonight. They make this list. There are some very interesting numbers over here as far as expectations from some of the major institutions and research firms that follow Apple. And Apple's been quite good to our roundtable portfolio. So again, why circle in the sky and look for carrion? I mean, when you can find companies like this. So tonight we'll talk about Buffalo Wild Wings. It has decent expectations from Value Line. They tend to be kind of tough on young emerging companies, but you can see that the analyst consensus have a strong outlook for the next year. The analyst consensus from all the companies have a very solid long-term perspective. Ken presented it a few months ago. Goldman Sachs also likes it, so we're going to go with Buffalo Wild Wings. Here's a look at the company. No stranger to many of you. Up straight and parallel, very well managed. Sally Smith and her team do a really nice job, but they have taken a bit of a crunch. Here you can see that the price is down fairly significantly here in the last bit, and they actually released earnings today, and they missed by quite a bit. And the stock price is actually down 10 to 15% in after-hours trading, so actually that's an interesting moment. But I've told many of you over the years that I think it's an opportunity, Ken. I mean, I really do, because the fundamental.
Oh, absolutely, Mark. Absolutely, yeah.
I just got to cry on the audience's shoulders for a minute. I finished my slides. The last thing I checked in was on current news. I knew the earnings were coming out. I expected them to be pretty much in line. They weren't. They had some pretty decent explanations about, well, the World Cup's not in this year and it was last year, and the basketball tournament didn't work out the way they had hoped, and they had fairly decent explanations. They're battling chicken wing prices and all that stuff. You can actually listen in. I've told many of you over the years that the number of times I've listened to a conference call I can count on one, if not two hands. Well, I used up another finger tonight. I did listen in and listen to Sally and her team, and the analysts asked the questions, and I'm pretty satisfied with what I heard. I'll probably do a little bit deeper digging, but I'll include a link to the the transcript and the audio for that report. Again, I see a company that's not being too aggressive with expansion, pretty much firing on all cylinders, and the graph doesn't lie. So that 15% price drop today, to me, is going to be an opportunity to be okay in the long term. Here's just a quick look at that same information. If you want to see the numbers, we're talking about a company that back with the Value Line report at the end of February that will be updated in about a month, where they're talking about a return forecast of about 14% based on a 17.5% growth rate, net margin in the 6% range, and a PE in the low 20s. And I think the graphics show you that those numbers are not anywhere near insane. I mean, the net margin may be atrophying a little bit, but they've consistently been a 6% net profit margin company. You can see that the PE ratio does cycle, like Ken was talking about for Illumina. These guys fit that description a little bit farther down the life cycle curve, but the PE will cycle on a company like this. But again, we're talking about a PE that's somewhere in the mid to low 20s rationally. So again, with today's price drop, we're talking about a return forecast back in the 14 to 15% range, and I do like that a lot. Here's a look at a longer-term look. The company does overheat from time to time, as represented by those green peaks at the top on the relative strength index. Anytime it's over 70, the company may be getting a little bit ahead of itself. And one thing that I do take away from this graphic is the lower graph, 10 years of the stock price on a month-to-month basis. There is a bit of a support floor underneath the company, down around 120. We'll see if they test that tomorrow. But I'll tell you, if it drops to 120, I might have to put some real money to work in a IRA because it probably bounces off that. If not, could be other things going on. Here's a look at the Chronicle. Same thing. That I'll just reinforce and echo what Ken said. I see a company that's very high quality over the years. We'll get Kurt to move this legend out of the way so that we can see the full quality picture. But I also see a company that's taken a bit of a break. The stock price has plateaued over the last 6 months of the monthly price bars. But the long-term return forecast is up at least levels that haven't been seen in the last few years. So the return forecast is up there pretty well. Goldman Sachs has actually been increasing its interest in the company a little bit here lately. And I expect to see these forecasts begin to go up a little bit as, again, they get their handle on what's going on. And we do follow this on a fairly regular basis also. So we'll actually track some of that target price stuff for Goldman Sachs on behalf of Buffalo Wild Wings. So with that, let's hope that today will be the buying opportunity. We'll add it to the portfolio. It's a repeat selection. I think we've made it a couple of times, so it joins the family of repeat selections in the roundtable portfolio.
So Mark, my question is, do we buy it tomorrow at the opening price or do we buy it at the closing price today?
I usually buy at the opening price tomorrow, and they're usually the same thing.
Okay, good.
they're usually the same thing. But
I have a feeling this one might gap down, okay?
Yeah, it's gapping for sure. So I generally do buy just as if we were going to market first thing in the morning, and so we'll see how that goes. Okay, any other comments or questions? And I will include a link to the transcript because I know many clubs and individuals do have this company, and you might want to get a little bit better feel. I mean, some of the stuff that I got warm and fuzzy about was just the way they described their, sticking to their core approach and maybe nibbling at the edges with some strategies that might help a little bit over the long term. So with that, I wanted to leave plenty of time for Hugh because he's able to join us here this month, and he's going back. He falls into that stubborn category of he wants to stick with staples. So let's hear the story on staples. Welcome, Mr. McManus.
Hey, thank you. Yeah, I started buying staples for this portfolio some years ago, about 4 or 5 years ago.
Yeah, actually 6 years ago. It was the second month, Hugh.
And bought it, I think, 7 times, you said?
Yeah, I think that's right.
Expecting this company actually to turn around a little bit more aggressively as the economy recovered. But of course, we had a different kind of recession this time. So things aren't recovering as quickly as they should. And the other thing that's, I think, happening to Staples, even though it is a leader in the online world, is that it is suffering from competition, particularly from companies like Amazon that were really purpose-built to go head-to-head against an entity such as Staples. And the only thing that's happened in this space is that there has been a big merger between Office Depot and Office Max. An attempt was made for Staples to merge into one of them some time ago, but it was shot down. But that merger has gone ahead. And now Staples is proceeding with its efforts, Staples and Office Depot, to merge together. It's got a bit of a problem with the Justice Department, and I've been following that, and I'm quite actually intrigued with what is happening, the back and forth that's going on. If it works, it's obviously going to help both companies, and in my mind, there's no reason why it really shouldn't work, because as Staples is demonstrating from its growth of its own business area, as competitors are demonstrating quite amply, it's not the bricks and mortar stores that are the competition in this space anymore, it's online. Part of the effort, if it goes ahead, would be for Staples and Office Depot to carve off a big chunk of their contract business and sell it to Amazon. That's one of the topics that's in discussion. But right now the judge seems to be going back and forth, from what I've been reading, on whether or not he will issue an injunction. But we should know in about 3 or 4 weeks. If he does, and this merger gets called off, I think Staples is going to get taken out by a venture capital or an investment company, a hedge fund or something like that. Because there does need to be consolidation in this space. So let's move on here. We're just looking at what's happened earlier today. This is the stock price at Eastern time today. You see that it has plummeted quite a lot from its 52-week high of $16.84, but it's up about 25% from its low of a few weeks ago. It has been on a bit of a roller coaster for the last couple of weeks, and I believe when I added it to the portfolio, it was substantially higher than it was today. Well, maybe not that substantial, quite higher. Company has a market cap of just under $7 billion, but when you look at what's going on with its income statements, its balance sheet, you just saw appear briefly. There we go. You can see that it has a relatively healthy balance sheet in the sense of cash on hand. It is not a bad cash generator. And we'll move on and look at the bottom of the balance sheet where we have the liabilities. Staples is also like many other companies in that it leases a lot of its properties rather than buy it. So while it does have long-term debt, it seems to have a relatively good value between short and long-term debt. If you bounce over onto the income statement, which is really where the rubber meets the proverbial road, you can see that this is where the problems are. You can see that the revenues in this company have been declining pretty steadily, $1 billion a year, for the last 2 years. That's an exceptionally bad sign, and a sign that this marketplace is changing and changing quite dramatically. There is no real long-term solution to declining revenues other than changing the business model. And that's what they are actually trying to do, at least change their business approach. Skip to the next slide, we can see statements of cash flow. There's not a whole lot of news in here, other than the fact that the cash flow from operations mirrors what's been happening in the income statement. The fact is that fewer people are walking in and buying things in the stores. There are other outlets for the computers with higher margin items that they used to have. And while they still do have a lot of contracts, major contracts to Quill, etc., with companies, it's only half of the S&P 500, and it's a signal to me that there does need to be some kind of consolidation, further consolidation in this industry. So let's move on. The company does continue to weaken. It is in a very competitive market. The government is fighting its attempts to merger, but the trend in the court looks relatively good so far. They will have to sell some assets. And if and when the merger occurs, they will divest themselves of a lot of stores, maybe 40 to 50% of the job, maybe not as high as that, but it could be as high as 40 to 50% of the footprint that they have nationwide in terms of stores. That's not what the growth in the future in this company is, as has been amply demonstrated for the last couple of years. And then we skip along to the next slide. We learned some interesting facts. It is the #4 e-tailer or e-commerce retailer in the nation after Amazon, Apple, and Walmart, which is ramping up quite aggressively. It serves about half of the Fortune 500 companies, almost 90,000 employees in 26 countries, and offers next-day delivery to almost the entire nation. Delivery is the area, this is online, that is growing most rapidly. Bricks and mortar is not. And this is kind of symptomatic perhaps of what's happening in the retail industry overall, where I believe there has not been a new mall built in these United States for almost 9 years.
Wow.
Very telling. We'll skip along to the next slide. And these are highlights taken from the latest presentation in March from Staples, where they're touting what the recent accomplishments were. Most of the sales, almost half the sales, are in the US. It used to be a lot more than half, but the international expansion is moving along very aggressively. And there is a market for Staples overseas, from Australia to Europe to Canada to Mexico. Skipping along to the next slide, we can see how the product mix has evolved over time. Business technology. The left is the historical number from 2011, and the right is from 2002. So you can see how business technology, anything to do with computers, has been on the decline, as has core office supplies. But ink and toner, interestingly, and paper, the meat and potatoes of this end of it, have been pretty stable. But services is an area that has grown pretty rapidly, not quite doubled, but close to it, as well as facilities and break room supplies. And you can see on the other side from the channel mix that the retail, the bricks and mortar store, has declined steadily in the last 5 years, and that has been a growing trend actually for the last 10 or 15. We skip to the next slide. We can look at where the growth, the engine's growth in this entity is, and it really will be in the service area. And they're revamping many of their stores and trying to get experts into the store, like the kinds of people that you would meet at Best Buy, etc. Not that they're anything to shake a stick at, but maybe almost like the Apple Genius approach from their stores. But they're driving the contract business in particular pretty aggressively. And if we skip along to the next one, they talk very glowingly about their online presence, and it is very impressive. At one point, it was the #2 e-commerce retailer in the country. It's still growing, and it's still growing at a relatively decent clip. Others have been growing faster as they pivot online, particularly Walmart. But it was the #2 e-commerce retailer after Amazon for many, many years. And then if we move on a little bit further, it is expanding its channels and adding more expertise, subject matter experts, if you will, into the store, expanding its print and copy facilities, which is going to be more and more important as the economy gradually gets into a much better recovery. These are areas where it's trying to stem the tide in its retail store. But it does recognize that that is ultimately not the future. Hence this attempt to merge with Office Depot. And finally, go to the next slide. I think this is the last from the presentation, maybe not. But I call it footprint optimization, which is a term I heard from a major pharmaceutical company. When I asked them if they were closing manufacturing plants, the response was, no, we are not. We are optimizing our footprint. I thought it was quite nice. But that cutback has been really, really stellar. I mean, they've cut about 300+ stores in the last 5 years. And that elimination of stores will continue, but they will pivot more into a service entity and use square footage in their stores for other things. People might be able to rent a small office in there, ideas like that. We'll see how they actually move. But I can tell you, if they merge into Office Depot, you're going to see wholesale closures on a scale much larger than we've seen to date. I think there is one more left. And yeah, there's 2 more actually. There's a lot of cost cutting in this effort as well. You can't cost cut yourself into long-term sustained profitability. It's good to get the fat out to the extent that you can, and that has been quite impressive, almost $250 million over the last 3 years. Not bad at all. And then I think finally, we're looking at their non-GAAP sales and operating income. And this is their effort really to signal that while the news is bad, it's improving. And the fact is, it is improving. The financial statements are improving, but they're not anywhere near where they should be. And to skip along to the next slide, I think this is when we start to look at the SSG. And there you can really tell a very sad story with this company. The sales, this is not enough straight and parallel. If it is parallel, it's going in the wrong direction. But the pre-tax profit margin is the real teller. In any SSG that you look at, when you see a declining pre-tax profit margin, it's a huge, huge red flag. And I recognize fully that this is not an NAIC/better investing type company. But we have a bundle of it in the portfolio, and I'll explain in a while why I think it will bounce back price-wise. But I think for the long term, this company needs to pivot on its business model. It's a turnaround situation, which are all turnaround situations are always fraught with danger, because you're basically starting from a brand new company that you don't have a history from into a turnaround. Plus, you don't even know if management can turn around. But this market itself will continue to grow, and even if you have a future sales growth of a few percentage point, you can skip on to the next slide. You can look at the real telling area. I think one of the most powerful intrusions in the company's financials is part 2 of the stock selection guide, where you look at pre-tax profit and return on equity. These two things should really move in parallel. You could argue they are here, but not in the right direction. They're moving down. But the company is in recovery mode. And then on the next slide, we can look at how its price-earnings ratio has been doing. And that's been a bit of a mess as well, where it's ranged from close to 40 down to 20. I've cut it back a little bit more dramatically in the 10 to 20 range. And there was a time, of course, where it didn't generate any earnings at all. And so those numbers are X out of this calculation. And then the final slide, part 4, where we're looking at pretty much whether this is in the buy zone. It is, and it doesn't really take any manipulation to get it in there. This company is suffering. But if you have a growth of 1 or 2% a year, you can still find that this company will sit in the buy zone with relatively conservative estimates of other things. So moving along to the next slide. The reason that I'm looking at this company in particular is I'm partially driven to these sorts of companies because of the background in biotech and the way that I analyze these companies. I find Staples, and I've owned this company for many years, but I find it to be a very interesting company because it's sitting in the middle of a market that is changing and changing dramatically, and has changed quite dramatically in the last 6 years since we started looking at it here online. And it's in the middle of an extremely important inflection point for its future. It really has to merge with Office Depot to cut the number of outlets nationwide so that it can make an effort to get back to profitability. My thesis is that if the judge decides not to issue this injunction and therefore allows the merger to go ahead, that the stock price should bounce back. And I'm more than happy at that point if we recover a profit in the portfolio to get rid of Staples out of the portfolio. So while I think it probably has a very successful future, I don't want to go on the ride with it anymore because I'm not sure what that future would be. I do believe it will become more and more of an e-commerce retailer, and it has a very good presence there. But it will go head-to-head with companies like, as it is right now with Amazon, and perhaps increasingly Walmart as well, even Target as they expand into this market, once the retail landscape is cleared. Mm-hmm. If it doesn't get that injunction from the judge, if the injunction is issued and the attempt to merge is delayed, I think the merge will ultimately go through, but it would be expensive at that point to fight it. I think there's a chance that Staples will get bought out because so far it's not been a super well-managed company. It could be managed better. And I think the people behind the wheel at Staples should have cut back much more dramatically on the number of stores, because that's what the market is telling you, and pivot more aggressively into the online world. I think for a company, I'm not very sanguine about Staples. I think for a stock price, which in my personal opinion is one of the worst ways to invest, but this is what I'm doing with Staples, for a stock price, I'm a little bit more upbeat because I think there is upside in what is going to happen to Staples in the next 6 to 18 months.
Hugh, do you have a price in mind that would,
$22.50.
how much?
$22.50.
That would,
You asked, Mark. You asked, Mark. Okay.
I'm sorry.
I have a order in from my own holdings of Staples to sell it at 22.
20? Okay. I mean, that's,
$22.50.
that's not,
$22.25. Huh?
it's not science fiction. I mean, it was as high as what, 19 and a half, not that long ago.
Yeah, well, the good thing about people who get involved in the market, and I'm not talking about us here, is there are a lot of euphoric nut jobs, as we talked about with Illumina, will pick things up crazily, you know? And I celebrate those people and honor them by selling overpriced shares to them whenever I get the chance.
Oh, we're going to have so much fun in Washington when we talk about this. Excellent. Well, thank you, Hugh. Awesome stuff. Ken, I think we can go ahead and launch the poll.
Okay, give me just a moment here, Mark.
Last month's results, I think, are showing there to the audience, but we'll go ahead and go for it. No, I get it, Hugh. I mean, it's definitely a re-engineering work in progress, and it's what I find so fascinating is it was such a stable company not that long ago.
Yeah, that's the thing. It really was.
I mean, it was the survivor of the whole bunch.
The way it pivoted online and became super successful there, a real skill set. But management doesn't seem to have the skill to manage a downtime. And part of that is because they've never really experienced something like this before. And there are probably hedge funds in there that put a good management team and sort the whole thing out, you know?
Mm-hmm.
And it will involve hacking back aggressively on its footprint or really changing what it uses some of the space in the retail stores for.
If you haven't voted yet, just use your mouse and click on the stock that you think we should add to the portfolio. If you don't think we should add any of these, then click on none of the above. We're up to 82% of our audience voting here. Let's see if we can push it to 90%. Just make a click. It's really easy, and nobody knows what you voted for, so Mark can't get at you.
It does. I think I can figure that out.
Right.
Seriously, if you're here for the first time, you're welcome to vote. We encourage the entire audience to go ahead and express their opinion.
Yep.
Even when it's wrong, it doesn't vote for me.
I'm going to count down in my mind about 8 seconds here and then close the whole thing down. It's really easy, folks. Just do a click. Okay, let's close that down and share the results.
I can't see the results, so I'm going to go way out on the limb and assume I didn't win this month.
Well, Mark, Illumina got 60% of the vote, and Buffalo Wild Wings got 29%,
Woohoo!
and none of the above got 7, and Staples got 4. So we're going to add 2 Illumina positions. I don't like this because I've been on a losing streak in the last year, and the audience keeps doubling my losing choices here. I don't know, Mark.
Well, it comes and goes, so I wouldn't take it too much to heart, Ken.
All righty. Well, here we go, and let's see if I can now hide that and you're back to your screen now, Mark.
All right, we're going to go ahead and switch gears. We're maybe running a tiny bit long. I'll just spend a couple minutes talking about the selling stuff. I think we will continue with this theme, if not next month, the following month. So we'll refine it a little bit, but just wanted to we'll come back to the coming attractions here in a minute. I do want to spend just a quick moment saying that all 3 of us we'll be joined by Cy Lynch at that second entry in Chantilly, Virginia. That's Washington, D.C. for the NEIC National Convention between May 19th through the 22nd. Would heartily encourage you to come join us if you want to come and debate us on our stock selections. We'd love to do that.
We will be sending out information on our list, Mark, once we get the actual time of the roundtable, we're going to be doing roundtable live from Chantilly. Once we get the exact timing, we will send out a reminder to everybody. We're not quite sure if the technology is going to be there to make that work real well for us, but we hope to be able to broadcast live from the convention, not only to our classroom audience, but also to the audience that normally comes in via the webinar. So we'll get that stuff sent out to you just as soon as we have a date and time.
Okay, Ken, I need a minute. If you could go ahead and talk a little bit about this next slide. I'll be right back.
Okay. We're going to be talking a little bit about selling. Mark and I have been involved in a lengthy discussion over the last 3 or 4 months about how to manage this very large portfolio that's being created by the roundtable. This is not a traditional portfolio by any means. We would never have this many stocks in a traditional portfolio. This is a portfolio meant to demonstrate good picks and then to try to meet some very specific benchmarks, and we talk about those every month. You know, we'd like to be 5 points past the market growth, and we'd like to have a 60% plus accuracy, but we think that we need some selling discipline in this portfolio. So we've been talking about a number of different ways to create some triggers. And one way that we finally have decided to focus on is using relative return as a trigger. Now, usually when you keep track of your portfolio, you keep track of the price, and you keep track of the growth of the price in that stock from the point you bought it at, but we don't usually in a personal portfolio track relative return for each stock relative to the market. We might track relative return for the whole portfolio and how is it doing compared to how the market would have done, but we don't do that for individual stocks. We do have the ability, however, in this portfolio to track that. So what Mark and I decided that we might want to take a look at is setting some kind of a trigger where when a stock hit a particular trigger, it would automatically come up and be something we took a look at, and we'd make a conscious decision then to continue to hold that stock or to freeze the position, which amounts to selling it off. We're trying to decide what an opportune number is for this bad relative return, and at one point the suggestion was made, well, how about looking at those stocks that have more than a 20% negative relative return? That means they're losing to the market by 20 points or better. We have discussed numbers a little bit smaller than that, maybe even 15 when it starts losing to the market by 15 points or better. But here's a list of the positions that are losing by more than 20 points at this particular time. Notice there's 4 or 5, maybe even 6 fossil positions in there. And then there's a couple of doubles and maybe even another triple or so. There's a triple on Copa Airlines. We did note that a number of these, not too many of them have to do with the oil crisis. We do have Oceaneering International in there, and that's an oil stock, and of course it got hit pretty badly when the oil price took a plunge. But a lot of these we've decided have a lot to do with currency issues. Now there are some that just don't have any reason why they're doing badly, and we're thinking that it might be a good thing just to freeze these positions. So Mark, I've been kind of vamping. Why don't you give us an idea on what you think about this whole thing that we're talking about here?
Again, we're talking about something we're almost talking out loud or thinking out loud. Very much like we do for the challenge concept, where we'll take and challenge the companies with the weakest return forecast, decide whether it's a true special situation or if the company, a lot of times when a company shows up on this list, it's because it's actually done extremely well from when we picked it. So, I mean, we want to talk about whether or not we should exit a position. It probably should, be a function of whether it's a core or a non-core company. But we're thinking about using the challenge concept in combination with this return forecast and what Ken was just talking about. And let me give you kind of a where the rubber meets the road type example. I actually did this already. You can go back, and a year ago, I nominated Iconic's brand group. Actually, April of last year, so $1,000 was invested in Icon back then. And here's a chart that you can prepare on Finance Yahoo, where I've inserted a comparison. And the comparison of Icon versus the Wilshire 5000 using the VT-SMX as the benchmark. So you can actually track the percentage difference. And the point that I'm illustrating here on this graphic is there was a point in time early in August when it began to trail the Wilshire 5000 by 20%. So that what we're actually talking about doing is when a company begins to trail the benchmark by, let's say 15%, maybe 20%, it's subjected to what's going on, should we, lick our wounds and move on type thinking. And in this case, if we had done that, we did, by the way, because back in that, when I made the nomination, I said, if this thing trails the market by more than 20%, we're going to just exit the position, and we did. Well, we lost 20%, but look at what happened to the company afterwards. And again, this kind of comes back to Ann Manning's disruptive situation where you can't see everything coming, other shoes dropping, that sort of thing. It would now be worth $330 in the portfolio if we'd hung on to it. So again, it's a protective measure, that obviously there's something going on here that was not foreseen at the time of selection. So again, I think it's the type of thing we want to kick around, talk about in a little bit greater detail, perhaps even build out better tools to support this sort of thing. But I think it has some fairly considerable potential to keep us from having, large loss situations. And again, it's kind of a step back, challenge it. I would look forward to any comments that anybody in the audience might have or suggestions for this sort of thing as we air it out in the forum. But does that make any sense to any of you? Ken or Hugh, do you have any thoughts about, tracking?
Well, Mark, I'm going to bring in comments from two people in our audience. Okay, Annie wants to know, where does one find the stocks held in this portfolio? And at the very beginning of the session, Annie, we went over that. If you go to the Manifest Investing website, the public side of it, you don't even have to log in. Off to the right, you'll find a list of portfolios that you can take a look at. And one of the portfolios is called the Round Table portfolio. It's actually in a nice dashboard, and Mark's showing you that dashboard right now, and it'll show you all the holdings. What it doesn't show you is the relative return coming from each choice, because right now, at least, the dashboard's not set up, and I don't think I don't mean to intimate that it's going to be set up that way either, but it's not set up to show that kind of a value. But we do follow it on a spreadsheet where we can calculate relative return, comparing it to that VTSMX, the Vanguard Total Stock Market Index. We're also getting a comment from Mary. Says, what are you using for market return? And Mary, each stock is compared to that VTSMX at the time when it's placed into the portfolio. So VTSMX has a different value every single time the round table meets, and it's from that value that we compare and calculate the relative return of whatever holding we're looking at. John wants to know how we calculate relative return. John, it's just a simple, if you put money into the VTSMX, and if you put money into the stock, and then you compare the two numbers. If the stock is now worth $2,000 and the VTSMX is worth $1,000, then you have a really nice relative return of 100%. Mark, I'm going to stop for a moment here and let you continue to talk about what you're talking about here on these slides now.
Yeah, again, the calculation is pretty simple. It's the annualized total return for the stock in question at the very top, that ticker symbol ASPS, down 51.1% during a period when the stock market's actually advanced 1.8% per year. So you literally, it's just the total return column minus the market return equals the relative return. So again, from a, step back 35,000 feet, Bill O'Neill, the editor of or publisher of Investors Business Daily, and their system, he basically talks about having a stop at an 8% absolute return, a negative 8% absolute return, you just jump out of the position. As Ken was saying, heck, we have stocks that do that during a day. So that would probably do a whole lot of toggling and jumping around, but much more active than anything we would be used to. We think watching the return versus the market could be very unique, and again could hold some considerable potential for limiting deeper losses. So again, I don't know the answer to the question. We just put it out there, and we'll see where it goes.
Mark, Nick has a real interesting idea that we might mix into the whole conversation. He says maybe you want varying differences in relative return before you exit the position after you take into consideration the quality of the company.
Absolutely.
So that there might be a little bit more leash given to higher quality companies than to lower quality companies. Bruce says, interesting, Illumina is in the negative 20 relative return, but the audience just said buy more.
Mm-hmm.
Well, Bruce, yes, absolutely. It's part of the discussion that we've been having. In fact, maybe we started the position in Illumina a little bit too early. Maybe that was not a good entry point into the stock, and we're at a more opportune entry point. I can't answer that question, but it certainly is something that we're constantly thinking about. Ann is suggesting, Mark, that these companies that have lost so much, what happened to their quality rating? Well, the quality rating is right there on the chart, isn't it? No, it's not.
It's not on this particular chart, but yeah, that's something worthy of looking at.
Yeah, we have a hand in the air, Mark, and I'm going to try to find out who that hand belongs to right now. If I can move my control panel around enough to make it work. Nope, whoever it was took their hand down. It was inadvertent, so the hand is down, but I certainly think that Mark and I are going to have 6 hours to discuss this going to Pittsburgh and another 6 hours to discuss this coming home from Pittsburgh this coming weekend. When we get to Pittsburgh, we'd love to talk to any of you that are here tonight. By the way, folks, if you live anywhere near Pittsburgh, they run a really nice event, and it's this weekend. Mark and I are going to be there. They're going to have some great speakers from the local chapter. And if you have some time on Saturday, come on out and say hello. I know the Pittsburgh folks would greatly appreciate your attendance. And like I said, they run a really high-class event all the time. We're very pleased with what goes on when we visit Pittsburgh.
All right, so just kind of to sum up, we're not going to abandon the stuff that we've used all over the years. Make the portfolio better, monitor the quality, and again, in line with that thought about maybe they need to be variable. We certainly treat the return forecast conditions with differences for, with allowances for core versus non-core companies. We're just talking about adding this as a potential challenge type concept of, if the company really has done this 15 or 20% relative return decline, put it on the hot seat. The difference between Illumina and many of the other companies on that list are that Illumina has a high return forecast. Many of those other companies do not still have a high return forecast, and again, would probably fail in a rigorous challenge. So we just ask you to think about it. We'll be airing these out in the forum, and maybe in line with some of the stuff that Hugh is doing with Peter Lynch. For those of you that aren't aware of it, Hugh is running a book club where he covers a chapter or two every Sunday night in Peter Lynch's Beating the Street. I got to believe that some of these type of concepts are going to be part of that book club review over the next couple of weeks. So we look forward to seeing that. So I think with that, we're pretty much out of time, Ken.
Okay, and then we have some Q&A, Mark, that we want to maybe take after we do the official close. We have 4 questions here that I think we can handle pretty quickly.
Go ahead and close us down then. Thanks, Ken, and thanks everybody for attending, and hopefully we gave you some things to chew on tonight.